Welcome back to the deep dive. Today, we're really diving into something that affects almost everyone: federal tax procedures and penalties.
Mm-hmm.
I know, it sounds maybe a bit dry, like a potential snooze fest.
Yeah, maybe at first glance.
But honestly, once we pull back the curtain, you start to see the logic. It's actually surprisingly interesting when you understand the rules.
It really is. And knowing this stuff isn't just about compliance, right? It's about peace of mind,
Yeah.
knowing where you stand.
Exactly. So our mission today basically is to walk you through the whole journey. What happens after you file? What if the IRS comes calling? Audits, appeals,
And
courts.
the penalties, we need to talk about those too, and importantly, how you might avoid them.
Right. Plus that whole foreign account thing that trips people up. So by the end, you should feel, really in the know.
Definitely.
Okay, let's jump in. The U.S. tax system, it's built on self-assessment. You figure out what you owe, you pay it. Seems simple enough.
Uh-huh.
But, well, how does the IRS actually make sure people are doing that correctly, given it's mostly an honor system?
Yeah, that's the million-dollar question, isn't it? And the answer is largely the audit process.
Okay.
Its main purpose isn't just catching mistakes, though it does that. It's really about reinforcing that voluntary compliance. The possibility of an audit, even a random one, is what keeps the system working for millions of taxpayers.
Ah, so the threat itself is a big part of the enforcement. Interesting.
Exactly. It's a cornerstone of compliance.
So how do they pick who gets audited? This is where it gets really fascinating for me. Is it just bad luck?
Not usually just bad luck. There's definitely a method. The main tool is a pretty sophisticated statistical model. You might hear it called the DIF system, discriminant inventory function.
DIF system. Okay, sounds technical.
It is. Think of it like the IRS's internal scoring system. It analyzes millions of returns, compares yours to established norms for similar financial situations.
So it's looking for outliers, things that don't quite fit.
Precisely. Unusual patterns that might signal an error or, a potentially significant amount of unpaid tax. It's trying to pinpoint where an audit is most likely to find something.
Like a predictive algorithm for tax issues.
Okay.
What else puts you on their radar?
Well, a very small number are chosen completely at random just to keep that possibility alive for everyone.
Right. The random factor.
Then, if you were audited before and they found the significant issue, that makes a future audit more likely.
Makes sense.
And a big one, information return discrepancies. This is huge. When the numbers on your W-2s, your 1099s, the forms that banks and employers send to the IRS, when those don't match what you reported, that's a major red flag.
Okay, that's a direct comparison they can make easily.
Yep. And finally, sometimes, if your itemized deductions seem way out of whack compared to others with similar income, that could trigger a look too.
Gotcha. So let's say our listener, maybe the small business owner, Sarah, she gets that notice. How long after filing does that usually happen?
Typically, for individuals, most audits start within 2 years of the filing date.
2 years. Okay.
But the IRS technically can audit any time before the statute of limitations runs out. And sometimes you might even agree to extend that deadline if needed. Large corporations, they often face audits every single year. It's just standard procedure for them.
Wow. Okay, so Sarah gets the notice. What does the audit actually, look like? Is it always someone showing up?
No, not always. It really depends. The simplest type is a correspondence audit, usually done entirely by mail.
By mail. Okay.
Yeah, this is often for simple math errors. Maybe you forgot to sign something, put the wrong social security number, or those W-2 matching issues we just talked about.
Ah, so fixable things.
Right. You'll probably just get a letter with a revised calculation, maybe a bill, maybe a refund check. No formal meeting needed. Pretty straightforward.
That sounds less scary. But then there are the more involved ones, the formal examinations.
Exactly. Those break down into two types: office audits and field audits.
Office audit.
Yeah,
Next time you go to them.
pretty much. Or sometimes it's handled through correspondence too, but it's more involved than the first type. It's run by an IRS revenue agent, often used for individual returns, maybe looking closely at specific deductions or credits you claimed, like substantiating charitable donations or something.
Okay. Still manageable. Now, the field audit, that sounds like the one people really worry about.
It could be more intensive, yeah. That's when an IRS representative actually comes to your office, maybe your home, or sometimes your accountant's office.
They come to your place.
They can, yes. The IRS decides the where and when. But here's a key thing to remember, a right you have. You can make an audio recording of that examination interview.
Good to know. Okay, so let's say the audit happens. Sarah answers the questions, provides the documents. Audit's over. What's next?
Well, hopefully the issue is resolved. If Sarah agrees with the changes the agent proposes, she'll sign a form, Form 870. It's called a waiver of restrictions.
Waiver of restrictions. What does that mean practically?
It means interest stops building up on any amount she owes about 30 days after she files it. But, and this is critical signing, it means she gives up her right to certain official notices and, importantly, her right to take the case to the U.S. tax court or go through the IRS appeals process later.
Ah, so it's basically saying, okay, I agree. Case closed.
Essentially, yes, it closes the door on further administrative or tax court challenges for those specific issues.
But what if she doesn't agree? If she thinks the agent is wrong?
Good question. If they can't reach an agreement right there with the agent, Sarah will get a copy of the agent's report explaining the findings and something called a 30-day letter.
30-day letter, okay.
This gives her 30 days to formally request an administrative appeal within the IRS. It's her chance to argue her case with a different part of the IRS before things potentially go to court.
An internal appeal. Is there anything else for someone like Sarah, a small business owner?
Yes, actually, there's a process called fast-track remediation. It's designed for small businesses and self-employed folks. The goal is to resolve the issue within about 60 days using a mediator from the IRS Office of Appeals.
A mediator. Interesting. Does it always work?
It can be effective, but it has limits. It's generally not used for issues where there isn't clear legal precedent or, where different courts have already ruled in conflicting ways.
Okay, so Sarah gets the 30-day letter, she disagrees, and she decides to appeal. Tell us about this appeals conference. What's the real goal?
The main goal, the whole point of the IRS Office of Appeals, is really to try and settle tax disputes without going to court. It saves everyone time and money.
So it's like a negotiation stage.
Kind of. The appeals officers have more flexibility than the auditors. They can consider the hazards of litigation, basically, the chance that the IRS might lose if the case went to court. So they act as a sort of impartial mediator.
Okay. And if they reach a deal?
If they do reach an agreement, you sign a different form, usually Form 870 AD. This one is generally binding on both you and the IRS. Once it's signed and accepted, interest stops accruing. It's often a really good way to resolve things.
But what if? What if even after appeals, Sarah still doesn't agree? She's hit a wall within the IRS. What happens then?
Right. If no agreement is reached in appeals, or if she skipped the appeals process after the 30-day letter, the IRS issues what's called a 90-day letter. The formal name is a notice of deficiency.
The 90-day letter? That sounds serious.
It is. This is a really critical point. Because now, Sarah has only 90 days to make a big decision. Option 1, pay the tax the IRS says she owes. Option 2, file a petition with the U.S. tax court.
And why is that choice so important? You mentioned surprising implications earlier.
Because the U.S. tax court is the only place she can challenge the IRS assessment without paying the disputed tax first. If she wants to fight it in a different court, like a U.S. district court or the U.S. Court of Federal Claims, she has to pay the full amount up front and then sue the IRS to get a refund.
Wow, okay, so paying first could be a huge barrier for a lot of people.
Absolutely. A major cash flow issue just to get your case heard in those other courts.
So the administrative options are done. Now it's court time. Let's break down this federal judicial process. What are the key things Sarah needs to understand?
Okay, so you have trial courts. That's where the case starts. Evidence is presented. Then you have appellate courts, which review the trial court's decision for legal errors.
Got it. Trial versus appeal.
Your main trial court options for tax cases are the U.S. tax court, the U.S. district courts, and the U.S. Court of Federal Claims. Above them are the U.S. Courts of Appeals, and at the very top, the U.S. Supreme Court.
Okay. And what about proving your case? Who has the burden? Is it always on the taxpayer?
Generally, yes. In most civil tax cases, the burden of proof starts with the taxpayer. You have to prove the IRS is wrong.
That sounds tough.
It can be. But, and this is important for you to know, the burden can shift to the IRS in certain situations. If you provide credible evidence, if you've kept good records, and if you've cooperated with reasonable IRS requests, the burden might shift.
Ah, so record keeping and cooperation are key.
Absolutely vital. Also, there's a legal concept called stare decisis, fancy term, but basically means judges are bound by previous decisions in similar cases. Precedent matters.
Consistency in the law. Makes sense.
Right. And when you appeal a trial court decision, the appellate court can affirm it, agree, reverse it, disagree, or remand it, meaning send it back to the lower court for further action.
Okay, back to Sarah's big decision.
Yeah.
Which trial court? You said tax court lets you fight without paying first. What else makes it unique?
Well, besides the no prepayment rule, the tax court is specialized. It only hears federal tax cases. The judges are tax experts.
Tax experts. That could be good or bad, depending on your case, I guess.
Potentially. There's no jury trial in tax court. It's just the judge. And you can actually represent yourself if you choose to.
Represent yourself.
Wow. Yeah. And there's also a small cases division within the tax court for disputes under $50,000 per tax year. It's simpler, more informal, but the decisions are final, you can't appeal, and they don't set precedent for other cases.
Okay, so tax court, no prepayment, tax expert judge, no jury, small case option. What about the district courts?
U.S. district courts are your general federal trial courts. They hear all sorts of cases, civil and criminal, not just tax.
So the judge might not be a tax specialist.
Correct. The big things here are you must pay the tax first and sue for a refund. But you can request a jury trial.
A jury. That's a big difference. Might appeal to some people.
It might if you think your story will resonate better with a jury than a single judge.
And the third option, the Court of Federal Claims.
Right. This court is nationwide and specifically handles claims for money damages against the U.S. government, which includes tax refunds.
So like district court, you have to pay first.
Yes, pay first, sue for a refund. And like the tax court, there's no jury trial option here. It tends to handle larger, more complex tax refund suits.
Okay. And appeals go up from there.
Exactly. Appeals from tax court and district courts go to the U.S. Court of Appeals for that specific geographic circuit. Appeals from the Court of Federal Claims go to a specific appellate court too, and the Supreme Court. They rarely take tax cases, usually only if different circuit courts are disagreeing on a major point of law.
All right, we've navigated the whole process from filing to court, but let's talk about the consequences if things go wrong. The penalties. You said they can be the sharp end of the stick.
They really can. Sometimes the penalties and interest end up being more than the original tax owed. And there are both civil and criminal penalties.
Civil and criminal. Let's start with civil.
Okay. One specific one is for the earned income credit. It's less a penalty, more a restriction. If you claim it negligently, you might be barred from claiming it for 2 years. If it's fraudulent, it could be up to 10 years.
Wow, okay. What about just not paying enough during the year? Estimated taxes.
Yep, there's a penalty for failure to make sufficient estimated income tax payments. If your withholding and quarterly payments aren't enough.
How do you avoid that one? Is there a threshold?
Yes, there are exceptions. Generally, no penalty if the total tax you owe when you file is less than $1,000. Or if you paid, through withholding and estimated payments, at least 90% of the tax for the current year.
90%. Oh.
Or the common safe harbor rule. If you paid at least 100% of the tax shown on your prior year's return, though that goes up to 110% if your prior year adjusted gross income was over $150,000.
Got it. 100% or 110% of last year's tax is a common way to go.
It's usually the easiest way to ensure you're covered.
Okay. What about just not filing the return at all?
That's the failure to file penalty. It's 5% of the tax due for each month or part of a month the return is late, up to a maximum of 25%.
5% per month adds up fast.
It does. And if you're more than 60 days late, the minimum penalty kicks in. It's the lesser of $485 or 100% of the tax you owe. So even if 5% is small, you could still face a hefty minimum.
Ouch. What if you don't actually owe any tax?
Good point. If you don't owe any tax, there's no failure to file penalty. Also, if you have both a failure to file and a failure to pay penalty for the same period, the failure to file penalty is reduced by the amount of the failure to pay penalty.
Okay, they don't fully double dip there.
Right. And for partnerships and S-Corp, there's a separate failure to file penalty calculated per partner or shareholder per month. It was $235 per partner per month recently.
Okay, so that covers not filing. What if you file, but you just don't pay the tax you owe?
That's the failure to pay penalty. It's smaller, 0.5% of the unpaid tax per month or part of a month. Also capped at 25%.
0.5% per month. Still adds up over time.
Definitely. You can avoid it if you've paid at least 90% by the original due date, like April 15th.
Yeah.
And you pay the rest by the extended due date, assuming you got an extension.
Okay. Now, what about penalties related to accuracy? Like you filed, you paid, but your numbers were just wrong.
Right. These are accuracy-related penalties, generally a 20% penalty on the portion of the underpayment due to the error.
20%. Okay, what triggers that?
Several things. One is negligence or disregard of rules or regulations. Basically, not making a reasonable attempt to comply with the tax law.
Negligence.
Another is a substantial understatement of income tax. That's when the understatement is more than the greater of 10% of the correct tax, or $5,000. Specific rules apply for corporations.
Substantial understatement. Got
And then there's a substantial valuation misstatement. This is also a 20% penalty if you understate your tax by more than $5,000, $10,000 for core, because you misstated the value of property, like claiming a way too high value for a charitable donation of artwork, for instance.
Okay, so negligence, substantial understatement, substantial valuation misstatement all potentially trigger that 20% penalty. Can they stack these?
No. Importantly, the IRS can't impose more than one of these accuracy-related penalties on the same portion of an underpayment. So you won't get hit with both negligence and substantial understatement for the exact same error.
That's good to know. Now, what about fraud? That sounds like the really serious one.
It absolutely is. Fraud penalties are much harsher. The civil fraud penalty is 75% of the understatement that's due to fraud.
A 75%.
Yep. And then there are potential criminal fraud penalties. These can involve huge fines, up to $100,000 for an individual, $500,000 for a corporation, plus potential prison time.
Prison time. Okay. What's the difference? How do they prove criminal fraud versus just, say, negligence?
The bar for criminal fraud is much, much higher. The IRS has to prove beyond a reasonable doubt that the taxpayer willfully and deliberately attempted to evade tax. It requires proving intent. Civil penalties have a lower burden of proof.
Willful and deliberate intent. That's the key. Okay, so we've heard about all these penalties. How can you, the listener, actually avoid them? Beyond the obvious, like filing and paying on time.
The main defense against most penalties is showing you had reasonable cause for your position, that you acted in good faith, and that your failure wasn't due to willful neglect.
Reasonable cause, good faith, no willful neglect. What does that mean in practice?
It means things like relying on advice from a competent tax professional after providing them all the necessary information, keeping good books and records, making honest mistakes despite taking care, basically showing you tried to do the right thing.
So documentation and maybe professional advice are helpful.
Very helpful. Oh, and don't forget interest. Interest usually applies to underpayments, and it often applies to the penalties themselves, typically starting from the tax return's due date, so the total cost can keep growing.
Interest on the penalties, too. Oof. Okay. So, related to avoiding penalties, let's talk about taking positions on your return. How do you protect yourself if you're taking a deduction or credit the IRS might question? What are the standards?
This is super important for avoiding those accuracy-related penalties we just discussed. First off, if a position is just plain frivolous, meaning it has zero basis in law, like arguing wages aren't taxable, nothing can protect you. Disclosure won't help.
Right, frivolous arguments are out. What about legitimate but maybe uncertain positions?
There are different standards of confidence in a tax position. The lowest relevant standard is a reasonable basis. This generally means you have like at least a 20% chance of winning if challenged.
20%. Okay. What does meeting that standard do for you?
Having a reasonable basis can help you avoid the negligence penalty, even if you don't specifically disclose the position on a special form. It can also help avoid the substantial understatement penalty, but only if you adequately disclose the position. Exception. This doesn't work for tax shelters.
Okay, so reasonable basis plus disclosure helps with substantial understatement. What's a higher standard?
The next level up is substantial authority. This is a higher bar, meaning the weight of authorities supporting your position is substantial compared to authorities arguing against it. Think maybe a greater than 40% chance of winning.
Substantial authority, 40% plus.
Right. Having substantial authority for your position generally protects you from the substantial understatement penalty, even without disclosure. Again, doesn't apply to tax shelters.
So that's a stronger defense. Is there an even higher standard?
Yes, the highest standard is more likely than not. This means you have a greater than 50% chance of the position being upheld if challenged. This standard is often required for certain transactions, especially tax shelters or reportable transactions.
Greater than 50%. Okay. Now, you mentioned authority. What actually counts as substantial authority? Can I just point to an article I read or what my accountant said?
Great question, because this is specific. No, articles or your accountant's opinion by themselves are not considered substantial authority.
Really? Not even a tax pro's opinion?
Not as authority itself. You need official sources. We're talking about the Internal Revenue Code itself, Treasury regulations, final, temporary, and proposed, court cases, official IRS revenue rulings and procedures, tax treaties.
Okay, official government stuff.
Exactly. Also, legislative history like congressional committee reports, the Blue Book explanations from the Joint Committee on Taxation, IRS notices, announcements, press releases, and even private letter rulings or technical advice memoranda from the IRS, although those are technically only binding on the specific taxpayer they were issued to.
Wow, quite a list. So textbooks, articles, professional opinions not on the list.
Correct. They can be helpful for understanding, but they don't constitute substantial authority for penalty protection purposes.
Okay. And if you do have a position that meets, say, the reasonable basis standard but not substantial authority, you mentioned disclosure. How do you do that?
Use specific IRS forms. For disclosing positions that might be contrary to, say, an IRS revenue ruling or a specific part of the code, you generally use Form 8275, Disclosure Statement.
Form 8275.
If your position is contrary to an actual Treasury regulation, there's a specific form for that. Form 8275R, Regulation Disclosure Statement.
Okay, 8275R for regulations.
And then there's a really important one, Form 8886, Reportable Transaction Disclosure Statement. This is required if you participate in certain types of transactions the IRS has flagged as potentially abusive, called reportable transactions.
Reportable transactions, that sounds serious.
It is. These include things like listed transactions the IRS has specifically identified, confidential transactions, deals with contractual protection against loss, certain large loss transactions. Failure to file Form 8886, when required, carries its own significant penalties, separate from any tax understatement.
So disclosure is key for uncertain positions and mandatory for these reportable deals.
Absolutely. It's about transparency with the IRS.
Okay, last big topic, and one that catches people completely by surprise sometimes. Foreign bank accounts. FBAR. What's the deal here?
Ah, yes. The FBA report of foreign bank and financial accounts. This is critical. It's actually filed with FinCEN, the Financial Crimes Enforcement Network, not the IRS directly, though the IRS enforces it.
FinCEN, okay. What's its purpose? Is it about tax?
Partly, but its main goal is broader. It's designed to track money that might be used for illegal purposes, like money laundering or terrorism financing, and also to identify unreported foreign income. The key thing is the penalties for not filing can be incredibly severe, sometimes even criminal, even if no tax was actually avoided.
Severe penalties just for not filing a form. Wow, okay, so who needs to file this FBAR?
Any U.S. person needs to file if they have either a financial interest in or signature authority over one or more financial accounts located outside the United States.
Okay, financial interest or signature authority.
And the aggregate value of all those foreign financial accounts exceeds $10,000 at any point during the calendar year.
Any point during the year, not just year end.
Correct. If the combined balance briefly went over $10,000 on, say, March 15th, even if it was lower the rest of the year, the filing requirement is triggered.
Just $10,000 total across all accounts. That could catch a lot of people.
It really does. People with relatives abroad, people working overseas temporarily, even just holding foreign stocks in a foreign brokerage.
Okay, let's clarify. Who counts as a U.S. person?
It's broad. U.S. citizens, U.S. residents like green card holders or those meeting the substantial presence test, and U.S. entities like corporations, partnerships, LLCs, trusts, or estates formed under U.S. law.
Got it. And what counts as a financial account? Is it just bank accounts?
No, it's much broader than just checking and savings. It includes securities accounts, brokerage accounts, commodity futures or options accounts, insurance policies with cash value, annuity policies, mutual funds held abroad.
Yeah.
Basically, any account holding financial assets outside the U.S.
Okay, very broad. And how do you figure out that maximum aggregate value?
You need to find the highest value each foreign account reached during the calendar year in its own currency. Then you convert that maximum value to U.S. dollars using the official Treasury Department exchange rate for the last day of the calendar year, December 31st. Add up those maximum values for all accounts. If the total tops $10,000, you file.
Okay, find the peak value in local currency, convert using the year-end rate, add them up. Got it. How do you actually file this thing?
It has to be filed electronically. You use FinCEN Form 114 through the BSAE filing system on the FinCEN website.
Electronically only. And when is it due?
The official due date is April 15th of the year following the calendar year you're reporting. But here's some good news. There's an automatic extension to October 15th. You don't even need to request it.
Automatic extension to October 15th. That's helpful. What about joint accounts?
Generally, if an account is jointly owned by U.S. persons, each person has to file an FBAR reporting the entire maximum value of the account. There's a limited exception for spouses filing jointly.
So both owners usually have to report the full amount. Are there any other exceptions to filing?
Yes, a few. For example, owners of entities where a consolidated FBAR is being filed don't need to file separately. Also, participants and beneficiaries in things like IRAs and tax-qualified retirement plans usually don't need to report those specific accounts. And beneficiaries of trusts might be exempt if the trust itself is filing.
Okay. And record keeping.
Crucial. You need to keep records supporting the FBAR information for at least 5 years. That includes the name on the account number, name and address of the foreign bank, type of account, and that maximum value calculation.
5 years of records. Got it. Phew. Okay, that was a lot. We really covered the waterfront, didn't we?
They certainly did, from how audits get started through appeals, the different courts.
Right, those different court choices and why paying first matters so much. And then all the penalties, failure to file, failure to pay, accuracy, fraud.
And the standards for protecting yourself, reasonable basis, substantial authority, disclosure forms.
Plus that FBAR requirement, which is such a common trap.
Yeah,
Hopefully walking through all this helps you, the listener, feel more confident, more in control when dealing with the tax system.
absolutely. It seems complex, and parts of it are, but there is a structure. Understanding that framework, knowing about things like reasonable cause, the importance of records, the authority standard, it really empowers you.
It really does. So thinking about the self-assessment nature,
Yeah.
the complex monitoring by the IRS, the different paths through audits and courts, the penalties, it makes me wonder, what deeper questions does this raise for you about that fundamental balance? The balance between our individual responsibility to figure out and pay our taxes and the government's role in making sure that system is fair and everyone actually complies.